Shout out to Snowball, our incredible new sponsor, a private community where top entrepreneur investors share private deal flow, wins, tough lessons, strategies, get advice, and so much more. Check out www.snowballclub.com. Let's grow together with Snowball. Hello, and welcome to the How to Exit podcast, where we introduce you to a world of small to medium business acquisitions and mergers. We interview business owners, industry leaders, authors, mentors, and other influencers with the sole intent to share with you what it looks like to buy or sell a business. Let's get rolling. And now a moment for our sponsors. I want to highly recommend you get Acquisition Aficionado magazine. Every month, Acquisition Aficionado magazine brings you tactics for business buying and selling you won't find anywhere else. Learn firsthand from industry leaders who share their success stories, featuring in-depth interviews and stories from leading figures in the business acquisition industry. This multi-platform mobile magazine speaks to acquisition entrepreneurs wherever they are in the journey. And I want you to visit acquisitionaficionado.com today. Hello and welcome to the How to Exit podcast. Today I'm here with Stephen Speer, and we're going to talk everything about buying and selling small businesses and the financing thereof. Stephen, thank you for being here today. I want to thank you for taking your time, sharing your knowledge with us, and this is going to be a fun conversation.
Thanks for having me, Ronald.
Cool. We're always going to start off in our origin, kind of who are you? How did you get into this space? I always joking around. The famous joke that I do is, I don't know if it's famous, the same joke I do with every guy is, you were born and then you ended up on a show about mergers and acquisitions. How did you end up here? So give us your background, man. How did you end up on a show about mergers and acquisitions? What is it you do? And then we'll talk about the company too, like what the company does.
Sure. I mean, I've been in lending a very long time, as you can tell by my hair color, and I primarily focused from the start on business acquisitions. And then roughly 10 years ago, I got more specialized and really did a lot of acquisition financing within the e-commerce/SaaS space. And the business has very much evolved to the point, I mean, we've done over 500 transactions for over $1 billion worth of financing. And we're really quite involved with the M&A community, and it's always fun to see people throughout the year at various events. But I enjoy what I do, and I like helping people, helping either groups or individuals acquire businesses.
Tell us a little bit about what separates you from something like the SBA lending program and stuff, or the other options that are out there.
Yeah, I mean, we do SBA financing. That's a bulk of our business, but we also do business financing for lower middle market transactions, typically with enterprise values, let's say 10 million and above. I think our biggest deal we're working on right now is 150 million. So, but we do quite a bit of SBA financing. And what sets us apart is that we're very much specialized in doing SBA financing within the online business space, which is, there are a lot of different nuances there.
So when you say online, are we talking e-commerce, membership sites, newsletters, or just all of the above SaaS companies?
Yeah, e-commerce, which is kind of like saying Kleenex, it
Right.
pretty much incorporates product-based businesses. A lot of them sell on Amazon and Shopify and Etsy and some of the others. So we do that. We also do more product or more service-based businesses, like SaaS businesses, where they sell their services online typically. A lot are educational technology companies that are around. That's ever growing and ever evolving to be a larger portion of our business.
So what is an ideal client look like for you guys? Is it, if somebody came, they're listening right now, they're looking at buying a company. How do they know that you're the right fit?
I think it depends on also the size, but our lower market transactions, they're primarily professional individuals sometimes looking to get out of corporate America and running their own businesses. And instead of establishing their own business and having that risk of being a startup, they actually buy a business and then grow it from there. And usually they have some sort of either strong indirect or strong direct skill set to be able to accomplish that. So that's kind of the lower market silo. Our lower middle market silo, again, generally transactions from about $10 10 million to 250 million. Those are typically groups of individuals or two or three individuals, partners who have an established business who want to perhaps a roll up strategy and buy additional businesses and grow their portfolio.
Do you have anybody out there who has raised funds and what they do is I know I've interviewed 2 people in the last 7 days who they've raised funds. It's a debt raise, but what they do is they use their funds for fast closing, and then eventually they go through like a more traditional finance company like yours and refinance those acquisitions out so they can free up the capital to do more quick closings. Do you work with stuff like that too, or
Those are more difficult because there is a 2-year waiting period and generally, so no, not typically, we don't work with those types of scenarios.
the 2-year
And those
waiting.
generally are smaller acquisitions, like they're buying something for $500,000 and then they do it that way. But on the larger deals, there's typically not a necessity to do it that way. We shore up the financing for them. Sometimes there's an equity co-invest piece and they acquire the business.
Yeah, one of the guys I was talking to, they buy, assisted living facilities, so a lot of times they are, yeah, the short of $1,000,000 acquisitions and stuff, but he has a $100,000,000 fund that he's raised, but I don't know what the time scale is, but I wanna say that they have the ability to roll over or cash out at the end of every year, so he refinances a lot of stuff. A lot of his stuff is real estate backed too, he's buying the real estate underneath it, so a lot of times he can refinance the real estate and pay the investors back, but I was
Yeah,
just
it
curious.
makes it a lot, especially if they're stock acquisitions. Yeah.
Yeah. So tell me about the company. Tell me about kind of what you guys look for. How do people kind of pre-qualify or know that they're themselves qualify and the deals they're looking at? Where I'm kind of beating around the bush
Yeah.
for, I guess, is I hear way too many times where somebody brings a deal to a lender like yourself, and then the lender goes, "Well, you structured all this wrong. We're gonna have to restructure this to get it done." So, um, how do people prepare to get a loan from you guys?
Yeah, and that's very common, and that's why we have a kind of a program that, allows us to pre-qualify an individual really early on, typically before they even start searching, and then assist them during the search and be able to vet the businesses that they fall in love with during the search to make sure those businesses qualify for financing. And then when they're ready to move forward with their offer, we assist them with crafting their letter of intent or contract and making sure that the financing available and their offer mirrors each other. Because if they don't, back to your point, they're sitting there having to restructure their deal.
I hear of that a lot, actually. Pre-qualification, is it something online they do? They fill out a form, then have a call with you guys, or how does that work?
We have them fill out 2 basic forms online and schedule a call with us.
Mhm.
Then during the call, we deep dive and we really find out what they're looking for, what they're kind of get additional color on their personal liquidity and their business acumen, and really try to kind of inform them or educate them on the process. Many of them have never bought businesses before, so we're able to educate them, and we take very much of a on hands or hands-on consultative approach with our clients.
I know the SBA has their own set of requirements and stuff, and then most banks and lending institutions layer something on top of it, their own
Mhm.
criteria. What switches over when we get above that $5,000,000 acquisition price that SBA can do, and you're starting to do institutional type of lending where you're doing these 10, 15, 20, even $100,000,000 deals? What's different in the pre-qualifying process and, the process in general?
Is vastly different. So there are kind of three, let's call it three buckets. There's SBA financing, which is financing up to 5 million. Then there's financing for businesses, typically in kind of the $1 to $2 million EBITDA range, that not only have the SBA portion, but they have an additional conventional loan on top of that, which is called pari passu. So there's that type of financing. And then the lower middle market financing are typically, Ronald, for businesses of $2 million in EBITDA or higher. And that's a completely different world. And that's a world that we started playing in a few years back. And the pre-qualification process is vastly different because typically it's investor money that are buying these businesses, not individual. It's not based on individual personal liquidity. It's based on investor funds. And they provide us proof of funds, et cetera. And then as they look at businesses to acquire, We're able to vet the business and give them an idea of what type of financing. Well, if we give them a green light, what type of financing, what the deal structure would most likely look like. So similar, but not quite. A lot of differences, especially on the loan facility. The loan is completely different than SBA.
One of the reasons I was asking is I was on a call earlier today with a gentleman who has raised $235 million, and they're doing a roll-up strategy, and I won't say what industry it is or anything. I don't wanna increase because it's a brilliant idea what he's doing, and I don't wanna induce any competition for him. But one of the things they did in their strategy is they went and got institutional investors to back them up. So the institutional investors said that they'll finance up to 70% of the acquisition in this industry, and then they only have to put their money, their 30% for it. So they basically got to dip into their raise for 30% of each of the acquisition. And I'm sure they're going to make some portion of that be owner carry or earnouts or something like that. So an acquisition is going to be a mix of their money they raise, some institutional lending, and a little bit of earnouts to hit the full amount. Do you guys work with that middle, that institutional? Do you do,
We primary, I mean, we do have many of our deals do have earnouts and seller equity rolls and seller notes, et cetera, but we don't go to the institutional level.
how do you guys work with on these bigger deals? My curiosity is about the team because I know at the individual level, the SBA is gonna require some familiarity with the industry, some proof that you're able to run this company, some background. When you're looking at these bigger teams, how do you create a great team that the lenders are gonna approve of, the banks are gonna like? I bring a team to you, what is a rock star team for you guys?
On the smaller deals or the larger ones?
No, it's gonna be the larger ones, right? Usually the smaller deals are 1 or 2
Yeah.
guys, right?
Yeah, I mean, we do look at direct industry experience. A bank or a lender, be it private equity or a traditional bank, et cetera, they're not going to stroke a $10 million check or $20 million check to somebody who's never run a business before. So we look at the team, and typically each team member has a certain skill set, be it previous SFO or CFO, previous CEO, et cetera. And we just look at the overall team and also the amount of equity they're willing to bring to the table. And then we kind of work forward from there.
Alright. So, what are some of the tips? Let's start with the small deals because we have kind of multiple buckets we're talking about here. On the smaller deals, what would you say in your area of expertise, online transactions, e-commerce businesses, and basically anything, SaaS and all that, anything that's done online, what would be your tips for vetting deals to make sure that they're lendable?
As our clients search for acquisitions or search opportunities, they provide us with the SIM, the confidential information memorandum and financials of the business. And obviously, we already know their background because we've already talked to them and had discussions surrounding that. And then we basically cash flow the business and look at how the business is obtaining revenue, and we move forward from there. And then we basically do a debt service analysis to make sure the business qualifies for financing and how much leverage it qualifies with. So is it a scenario where 90% leverage, 80% leverage, et cetera, and kind of determine it from there.
Now, I know the SBA loans require personal guarantees and a bunch,
Mhm.
pledging your firstborn child and everything else, right? You're fully guaranteeing the loan with assets
Not
and
that
stuff.
bad.
I'm teasing. But, the mid-tier and the upper ones, how do you guys secure the loans on those for the institutional investors or the private investors? What are they
Yeah.
secured against assets too, or how does that work?
So I'll just start kind of with the lower ones. With SBA, like you mentioned, it requires a personal guarantee. And if there's available collateral, which is typically limited only to maybe primary residence where they'll put a lien on the house, those are those are requirements there. Our middle tier also incorporates a SBA 7A loan. So that requires personal guarantee as well. And then our lower middle market deals where we're providing capital from our private equity firms. Those don't require, they have no recourse. They don't require a personal guarantee. Every once in a while they do, but it's very rare because ultimately it's a corporation buying another corporation. So it's vastly different playing field there. So those don't require personal guarantee.
For each of these, what are we talking about timeline? I kind of understand the timeline of a typical SBA loan, but for what is the timeline for, just for everybody knows, what's the timeline to walk an SBA loan through you with you guys? And we'll talk about the others.
Yeah. So typical timeline once we have everything from our client is 60 days. Generally 30 days for underwriting, 30 days to close. That's pretty standard. The entire timeline's predicated on the expeditiousness of our clients. If they take a month to get us everything that we need from them, then you can add 30 days to that 60 days. So now we're at 90 days. And then the lower middle market tier, generally, it's vastly different. Generally, we're waiting on a quality of earnings report, but usually that's also all in, usually 60 days, about the same, basically. Far less pick intensive, I will say.
What are the lessons you guys learned over the years? I mean, with $1 billion of transactions, there's definitely lessons you learned about the industry. Are you guys concerned about the cycle right now in the economy, or how does any of that come into play?
I mean, in terms of lessons, I don't know. I think bad deals only get worse. So we tend to turn those opportunities down. Bad buyers only get worse over time. So those are kind of internal lessons. If we just don't like either the client or the potential client or the business, we move on to the next. We're not into doing, writing bad loans or working with people that we can't get financed. And that's led to last 2 years, 100% loan approval rate. Historically, we're at 98%. So if we're moving forward with a buyer, he's closing unless something out of our control happens. So, and we're proud of that, candidly.
That's pretty impressive because that doesn't exist in most other industries. It means you're vetting the buyers and the deal fairly well before you get there.
Yeah.
Because certainly the SBA doesn't have that type of closing rate on general. Like most of the brokers I talk to, the loan brokers, they won't claim that, right? That says you're doing a lot of pre-work and a lot of handholding through the process to make sure what's being presented to the bank is really well vetted.
Very much so. Yeah. I mean, that's why honestly that just about, or I'll say most online business brokerage firms use us exclusively. And sometimes buyers go to them with a financial institution already in mind, and they won't accept the offer unless they work with us, which is, it says, they have the option, but they normally don't get their offer accepted unless they work with us because we have the reputation of getting people across the finish line. And unfortunately, standard banking institutions do not have a good track record. They, on average, close 63% they get 63% of their loans approved, which is pretty bad. I think that's a D in school. So that's not a very good rating.
Yeah, I run into people all the time who they go to their local banker because their local banker says, "Oh yeah, we do SBA loans," but the local banker doesn't tell them we've never funded a e-commerce loan ever, right? If you look
Yeah.
at their loan history, yeah, they do SBA loans, but it's for mom and pop shops, plumbing, electrical service, everything that's in their little town around that bank. That's what they're used to. That's what their customers are, and that's what they're used to lending. When you come to them and say, "Hey, I want to spend the full $5 million for a e-commerce site doing $1 million in transactions," and the bank looks at it, it's out of their zone, their comfort zone. And in a lot of these small banks, even though it's SBA loan, they still have to go through an internal board approval to loan, especially a $5 million thing. So a
Yeah.
lot of times these buyers and stuff, they'll get on one of my networking meetings, go, "I've had 2 banks turn me down." I was like, "Where did you go?" "Oh, I went to my local branch and I went to the one of the bigger branches down the road." I said, "No, what I want you to do is, number 1, not all SBA loans are equal. Every bank has their own criteria they lay on top of it. Find the industry that you're in, like for you guys, e-commerce. Go out and find somebody that's what their last 10 loans were in that industry. They love that industry.
Yeah.
They know it. They're comfortable with it. They can walk you through it. They can help you get the deal done even." So it sounds like you guys do that for e-commerce. Is there any particular, like, if I looked at your track record, if I hunt it down, like, what's the last 10 deals you guys closed? Is it all SaaS or is it primary one? Is there any sweet spots where you just focus a lot of energy on, or is it pretty broad?
A mixture of SaaS and product-based e-commerce businesses. Yeah. I mean, that's the vast majority. But what's interesting, Ronald, we're doing more and more brick and mortar deals because some of our clients are looking at both, brick and mortar opportunities as well as online or, yeah, e-commerce opportunities. So, and they're like, "Gosh, you've been great working with you. It's been great working with you thus far, but I want to buy this HVAC business." And we do those loans. They're easier actually. So even though we're specialized in e-commerce, we're specialized because it's more difficult to do an e-commerce, to provide e-commerce financing. Whereas brick and mortar, we've done a ton of brick and mortar over the years, so it's a lot easier.
I think brick and mortar is easier because you have a lot of hard assets you can actually collateralize, right? I look for a lot of brick and mortar stuff especially ones that have real estate, because now and if I could buy the real estate with it, I'm a previous real estate guy. That's what I did before I got into this
Yeah,
space. So it's my comfort zone, and I know if I need money to close or I need help later on, I can do things like sell lease back, and I can free up a lot of cash by not owning the real estate and just leasing it from an institutional investor that'll back me. So, yeah, the e-commerce, that's one thing I was that's why I interviewed you, and, I wanted to interview some other people in the space because they're not necessarily asset-backed loans. Now, the SBA is gonna look for personal collateralization, but when you get beyond that, the asset is the business itself, right? And its
exactly.
history and the employees and the ability to prove that you've, been in business for years making money. Do you guys I know one of the companies we interviewed recently, they won't touch a company that's been around for, less than 18 months. Do you guys have like, to acquire it, is there like a normal is there anything like that, any type of requirement where if you're gonna buy an e-commerce company, it has to have been around for X, Y, X period of time? Hey there, How to Exit family. Today, I'm thrilled to talk about Snowball, our incredible new sponsor. This community is more than just an investment hub, it's a place where growth is holistic. A private community where top entrepreneur investors share private deal flow, wins, tough lessons, strategies, get advice, and so much more. Snowball is a network rich with like minded, experienced entrepreneurial minds, including investors, founders, CEOs, and doers, all dedicated to meaningful growth. Snowball threads are like a daily masterclass. This isn't just about financial success, it's about enriching your entire life. If you're looking for a community that supports your entire entrepreneurial journey with shared wisdom and collective support, check out www.snowballclub.com. I believe their approach to compounded growth in wealth, health, network, and relationships could be the game changer you've been seeking. Let's grow together with Snowball.
We look at mostly 2 years of tax returns, that encompasses 24 months, so 2 full tax years, and then we're good to go. But
Okay.
18 months, you're gonna be hard pressed finding anybody to touch your business that hasn't been around at least 2 years.
Yeah.
Yeah.
I was curious. I know
So
they went down to that. I was a little shocked because personally, I don't want to touch anything that I don't get to see 3 years of full. But I'm not. I'm 52. I turned 52 today. So when this comes out, I'll be 3 weeks, 2 or
yeah,
3 weeks older than 52. I'm not. I'm a lot less risk adverse than I was in my 20s. Right. I did a lot of startups in my 20s and 30s, and I guess I was in the military in my 20s, but in my early 30s and stuff, I did a lot of like, hey, let's throw some money at this and see if the market likes it. Right. Let's create a business. Let's do a startup. Nowadays, I look at these things, and that's the reason I'm in this space, in the merger and acquisition space, is I wanna see something that's up, running, has a history of it, and it's not mine to build and grow, it's mine to not mess up, right? If I get in and leave it alone and just help it do what it's always done, it's pretty safe bet, and then maybe I can tweak and make it do a little bit more, or bring in the right people, and they can help it do a lot more, but, I don't wanna I don't wanna pull 80-hour weeks trying to pull something out of the gutter. So, do you guys look at some of that stuff? I guess financial history, are there any type of turnarounds and stuff that you guys will back, or does it pretty much have to be extremely stable?
we don't catch fulling knives, so no.
Okay. Most lenders won't. I had to ask, but most
Still
lenders
are
won't,
getting
right?
that,
Yeah.
and I admire people out there that do catch fulling knives and turn the business around, but yeah, we're not in the scratch and dent business. We
And
mostly look at businesses that are growing year over year.
I've met a few. I've met a few, like, in the UK and stuff, because they have Companies House, and they can actually, like, early detect that. They can see when companies, because here in the United States, we got this cool thing where you can operate in a shoestring and behind on your bills, and scrap it and make it until you make it. In Europe, they can't do that. So the court can call you insolvent because you can't if you don't have the right balance sheets, basically. And it's a national database. So even as a small business, you have to report, I think it's either quarterly or semi-annually, that what your finances are. And if you're insolvent on those reportings, they can actually force you into insolvency court and shut you down. So there's guys out there who do turnarounds that follow those, that look for diamonds in the rough. And some of them, I've interviewed a couple of them that are just really good at that. Again, that's not my forte, but I was curious if you guys, you know, or if you have done loans in that realm where the team can turn it around so you loan them the money. It sounds like not. There's not many people that will. I would have been
Yeah.
shocked if you
Then
said yes.
you can find private investors that do that
Yeah.
where, you know, but not standard type lenders.
Where are you guys located? So, like, are you guys national? You're across, you go, can you lend in all 50 states or?
Yes. Yeah. Yeah. With clients, our headquarters are here in Tampa, but we lend throughout the country and yeah, we have no borders here.
Do you, I have a lot of international listeners, Australia, the UK. I host, twice a month, we host a hangout, like a meetup where we brainstorm and helping each other like solve problems inside of this space. A lot of those guys are from the UK and stuff, and they want to buy companies in the US. Are you able to help facilitate that? I know the SBA has some rules where the LLC has to be US based and the primary shareholder, I think, actually has to be US based. But do you work with, you know, did any of the programs you have, can my UK guys come to you guys and finance an e-commerce thing, or is that?
Yeah. So businesses over $2 million. Uh, I will say our capital providers are a lot more selective
Mhm,
when that's the case, but we have done businesses or have done acquisitions on US based businesses for foreigners.
yeah. Like, I know a guy right now I'm buying, he's in the UK, he has a trucking, has 2 trucking businesses in the UK that he bought and merged, and he's buying an $18 million one here. Now he's raising capital to close that, so $18 million is a total asset purchase. I mean, it's the purchase price. He sent me a message, he goes, "Who can help me raise 18 mil?" And I was like, "Yeah, I do," and I sent him a couple of links to people that raise capital, but it's equity, it's investor raised, and it's a company that
Excellent.
that's what they, it's a company that raises capital. That said, um talk about, like, the process, like, walk me through kind of what would a buyer or a search funder or whoever you call ETA guy, whatever you call it, the operator, the guy buying the business, what should they expect to walk through? What does it look like? Are they gonna be on calls with you? Kinda what is the life cycle of this? I know it's gonna be 60 to 90 days, but kinda set some expectations for the listeners of to what to expect.
Yeah, our process starts well before that point. Our process normally starts when people are ready to go look for a business. So typically they'll go to our website or be directed straight to us and we send them out a couple of links, a couple of basic forms to fill out, really easy. And then at the end of the last form, they click on scheduling a call and they schedule a call typically they'll schedule a call and we'll be on the phone with them typically within 24 hours, maybe 48.
Mhm.
And then we go over the assessment form that we have and then really do a deeper dive on what they're looking for and ultimately, educate them on our process in terms of as they're looking for businesses to make sure that they have us vet any opportunities that they're interested in moving forward with. And then we help them along every step of the way. And in many cases, help them with the LOI because most of them haven't completed an LOI before. So we help them with that. And they present their offer is accepted. And then we start the loan process along with them, hiring typically a due diligence firm to do that. So that's the process.
So you're involved through the entire process. So they come to you, you have some back and forth there. I'm just recapping this so I know it. You get a little bit of back and forth, and then they start vetting companies. They start actually doing their lead generation. They start talking to companies, and prior to an LOI, they're showing you these financials and saying, "Hey, I think this is one." So they're probably seeing 5 or 6 before they pick one and bring it to you and go, "Hey, I think this is what I want to do," right? And
Oh, absolutely. Would say 10 or 12.
I'm being nice.
And,
Yeah.
and then
Sometimes
we'll
sometimes
pre-qualify
100.
them. Yeah, we have some of those clients.
I
We
look I
can't
look
look
at a
at
lot more
all of
businesses
these.
than I make LOIs on, so,
We
alright.
basically tell them unless unless they had at least an initial call with the seller or really done a little bit more than a deep dive on the business, don't bring it to us because we have had those clients, Ronald, that are like, here are all these businesses I'm interested in. And we're like, no, you're right down to like two. And then we vet the business, we cash flow it, we look at the business and determine the revenue silos and whatever. And then with the intention of issuing a pre-qualification letter just to show them sources and uses. And then they're more confident. They've been pre-qualified. The business has been pre-qualified and now they're ready to move forward with their LOI. And oftentimes they allow us to help them with that. And then ultimately they hopefully get their offer accepted. And we also oftentimes help them build their acquisition team, which is going to include the attorney, us, the lender, due diligence firm, and all the players involved in moving forward and ultimately achieving acquisition success.
It's awesome you guys help with that because a lot of the guys think they can take on some of these roles they probably shouldn't be taking on. There's
Yeah.
not a single new buyer out there that should be doing due diligence on their own. I don't care if you're a CPA, there's something about a third set of eyes looking at financials and looking at them from a lender's point of view, even, a critical point of view of whether or not it's a good deal. There's a thing we jokingly inside of the industry call deal heat. You get excited and you're all you think that they're really attractive and you kind of overlook certain things because you just really want to get one done. You've been doing this for 6 months, 8 months, 12 months, and now you've got one
Yeah.
that's interesting. You fall in love with this thing, and you'll tend to overlook a lot of things. I don't believe anybody should be doing their own due diligence. I think we should all have a third set of eyes, even if you're good at it. You should have somebody else look at it from a non-biased. There's a thing inside of our own brain called cognitive biases where we believe
Yeah.
we want this, and all of a sudden, you know, we do that. I'll give you a good one. I grew up a painter's son. My dad and I painted houses,
Oh,
right? And he would paint one side of the house and I'd paint the other. And he'd go, "Okay, I'm done." He goes, "Okay, I'm done." And we'd switch, right? I go look at his side and I find all these spots. I'd be like, "Yeah, you missed this and you missed this," and he'd be on the other side of the house going, "Man, you missed this, you missed this." But if and I got so frustrated because I'd always step back and look and because he would tease me about it, like, "Look at all these spots you missed." I was like, I've been working on yours." And he goes, "That's why we do this, right?" If you work on something for a few hours and you look back, your mind actually tells you it's all done. You'll actually even on paint, even if you're changing colors, your mind will actually fill in the spots. It's weird. It plays tricks on you.
wow.
And then the other guy comes over and he's like, he knows you missed something and he just sees it. He's just glaring at him. And that happens with these financials. It happens with legal structures. Even if you're an attorney buying businesses, have somebody else do your legal due diligence. But I love that you guys are helping people build that team. If I'm an investor and somebody wants me to invest in a company, which I currently don't do at all because I'm trying to buy my own. But if I were to do that and somebody said, "Well, I'm an attorney, I'll do my own legal due diligence," I'd say, "Okay, we're done." Right? Just because I know that there's that cognitive bias. When you get excited about something, you tend to want to see the best in it.
If they don't, we've had clients in the past say, "Well, I don't want to hire an attorney," and we're like, "We're out. We're not working with it." Well, why? Because you're going to be asking us legal questions, and we're not attorneys. Because in the past, and historically, that's exactly what they do. They'll start asking us, "Well, what do you think about this?" And we're like, "We're out. We're tapping out." So we require our clients. Well, we don't. We just tell our clients, if you don't hire an attorney, we're not working with you. And it's not in a conceited fashion. It's just we're not attorneys, and it's just amazing. And then back to in terms of like the wrong way of going about acquiring a business, I kind of want to touch on that a little bit. We'll have clients come to us after their LOI is accepted. They don't have personal liquidity. They have no idea how they're going to buy the business, and then the business doesn't qualify for financing. And most people do it that way, which is amazing to me. They don't have a clear, concise way of ultimately crossing the finish line with an acquisition. Even clients that come to us and we pre-qualify them, we lead them to the water, but they'll come to us with an LOI, and it happened actually today. We tell all our clients before you go forward with an LOI, even if you don't have us look at the LOI before it's accepted, have us at least vet the business to make sure it qualifies for financing. We had to convey bad news to one of our clients who decided to go on his own and not have us vet the business. And ultimately, business does not qualify for financing, and he's under LOI, so he's going to have to cancel.
Yeah, lucky for him or them, most people make their LOIs non-binding, which I didn't understand at first, but I kind of get now. But, there's just something to be said for planning ahead and knowing how it's done. Now there is a strategy inside of it. I know 2 people that do this. They go out, they know that the business is not lendable. They know it from start, but it's a good business. It may not be lendable because of the industry it's in or just it's maybe too new or they just changed, markets, too recently. They made too many big changes recently,
Mm.
and that scares a lot of the lending institutions. But they know that, and they go ahead and say they go through that, they do the LOI, and they take it to a lender, and they come back and go, "Hey, we're gonna have to renegotiate this. You're gonna have to own or carry more of this, or seller finance a lot more of this. It's just nobody's gonna be able to get a lender." I've talked to 3 of them, and it's not lendable. And I knew they knew that beforehand, right? It's a negotiation tactic. I don't think it's fair, but a lot of times sellers don't wanna hear that their business is not lendable, right? So now,
Yeah.
when a business is not lendable, they have 2 options or 3 options: keep the business, 4 options: keep the business, sell or finance the business, find a full investor who has, like, the full amount or stroke a check, and those are far and few between for most of these small businesses. Most people don't
Mhm.
wanna, do that, or they have to just shut it down, like, retire, and I'm sure there's more than that, but it does happen. But these guys see it as an easier conversation. They go, "Yeah, yeah, we'll go talk to the banks," and they give you the full check, and then they know what, they've been in the business too
Yeah.
long to know that this just isn't gonna happen, right? I had one recently where they made too many changes recently. I said, "Look, if I take this to any lender on the planet, they're gonna tell us, 'No, you changed too much in the last year. Your revenues went from 3.5 million to 1 million. You're still now it's starting to climb back up and stuff.' But when the bank starts to do the due diligence, their own background on this, they're gonna see the reason it dropped so much is you made some major changes to people in the company, changes the structure on how you manage. That stuff hasn't vetted itself out yet. You're not a stable company yet because you made these changes and now it has to restabilize, and I don't think a lender on the planet is gonna touch you guys."
And those are the same people that spray and pray LOIs all over the place. We know a few of those characters. They're on our you know what list, and if they contact us, we don't even reply. They just like LOI, 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 and they never close on anything ever. So
It was bad when I was in the real estate. It's even worse in the real estate community. In the real estate community, when the market's reasonable, it's not super hot. I know investors that would literally submit 2 to 300 offers on sight unseen on houses a week. And then what they and basically just did a mathematical calculation that if the house is in perfect condition, I'll offer 75 or 80% of perfect condition of the house. And then if the seller reaches back and says, "Yeah," or so much percentage under the current listing price, if they say, "Yeah," then they accept the offer, then we have our, inspection period, and then we come back after the inspection and say, "Oh, wow, this is all the stuff we found, we have to renegotiate the price." And they succeeded doing it. I mean, they were getting deals done. But man, that's irritating, especially if you're, like a business like we were, who had 30 or 40 listings on the market all the time. I just got to where if I seen an offer from these 4 or 5 companies, I knew what they were up to, and, like, I just denied it right off the bat. I never signed one of them, right? Because I knew
yeah.
that wasn't the offer. That was the get us under contract, make us take it off of MLS, right? Take it off the market. I'll tell you the problem with that is, and it's happening in the real estate world already, it'll happen in the business world too, as this becomes more popular and people are scattering those LOIs. There's a thing, I mean, in the commercial world, we can sue for non-performance, and, if you I think that somebody's gonna breach that, like, they say I tell you it's the LOIs are non-binding, but if you have a non-compete on top of your LOI, like we do, if we put an LOI in something, we have like a 60 or if I'm gonna pay for due diligence, I want a certain period of non-compete. You gotta take it off the market. I think there's a failure to perform clause. In commercial real estate, if I put an offer on your place and then I don't turn around and close on it, I can be sued for failure to perform on the contract for any losses that person would have had for having not taken it off the market. And it's fairly
Okay.
common. I think that enough people get burned, enough business owners get burned. I always joke around, you're one senator's son away from having a new law that'll change this thing. You're gonna burn somebody's son or kid or whatever, and also we're gonna get the same way we have interesting laws regulating real estate investment now that didn't exist 10 years ago. It's the spray and pray. The more people go out and do these loose knit methods that dirty up the market, the more rules and regulations will be put in to stop them from doing it. If they're hurting business owners, it originally, that's how things get regulated.
Yeah, it's unethical. It's unfair. I mean, imagine selling your business. You pull it off the market for 6 weeks, 8 weeks, whatever that number is, and then the buyer, yeah, I'm backing out. I think honestly, I think LOIs are need to go away. I think people need to go straight to contracts, put down earnest money, just like real estate. That's my own personal feeling.
Unfortunately, that would be great if more business owners were honest and accurate and there was less things that popped up in due diligence. The reason LOI is there is so that we can start due diligence, and I haven't seen one yet that the story didn't change drastically, especially when a broker's involved. I've yet to see a very honest, very straightforward, 100% no change broker on any deal, and I haven't heard of them yet either. So, usually it's built into the market some, but, you're gonna find stuff during due diligence. You're gonna find stuff that, I always kinda akin it to a poker game. The first set of financials, the first thing they show you is their poker face, they're bluffing, right? There's something else there, like, they don't really have 4 aces underneath there or a royal flush. They got a crappy little straight or something that you could beat, until we get more transparency in that, I think the LOI is just a placeholder for, "Hey, I'm really serious. Now show me your financials, show me some more serious paperwork." But I could see it going away if we were like Europe and they had Companies House where they federally had to report their financials on a regular basis and they had to be fairly accurate, maybe, that could go away.
Yeah. Or somewhere in between, like not LOI, not contract, but somewhere like in between.
Yeah, some of the deals, they go LOI and they do what's the next one? No, there's a letter of intent, then there's something else
SBA.
before contract. I forgot the initial. I don't know too many people that use it, but, you have a letter LOI, letter of intention, and then there's we always put, non-compete clauses on it, but a lot of guys will step into kind of a more formal thing before they do the due diligence. I'll think of it in a second here. But,
Well, there's a
huh?
indication of interest, then letter of intent, and then typically it goes to asset purchase agreement or stock purchase
Yeah.
agreement.
Yeah, I'm thinking more along the asset purchase agreement, but I forgot what I was talking to one group of people, and before they enter due diligence, it becomes a lot more binding, right? That the seller can't back out because some of these due diligences, you do legal due diligence, financial due diligence, stuff like that. You could be talking tens of thousands. You should be talking tens of thousands of dollars on $1 million EBITDA company. It's gonna cost something, right?
Typically, it's about $30,000.
Yeah,
Yeah.
yeah,
If the quality of earnings reports I'm more referring to, those are 30 grand. I mean, starting, you buy a very large company, let's say $100 million plus, it's going to be a couple of hundred grand.
yeah. Now I'm referring to just the financial due diligence and the legal due diligence on even an SBA deal. Those are, still going to be probably 10 to 15,000, right?
Right. 10 grand for not only legal, but probably 10 grand legal, 10 grand, standard due diligence.
Yeah.
So yeah, it could add up really quickly.
It makes you really pay attention to what you're going to go into due diligence on because you better be pretty sure because that can add up pretty quick, right? If you have think about you go through four of those before you actually get to close, right? You got 100 grand tied up, 80, 90 grand tied up into failed closings. I've seen it in the real estate world where we have escrow, we have to fight to get the money from escrow back because a lot of times it's just hard to get those checks back. So it got to where our closing attorney, I would never give a escrow check to anybody but our closing attorney, right? Because I know I could get it back from him if they failed to close. So,
Mhm.
tell people how they can get a hold of you. Tell people, like, kinda if somebody has more questions and they're not quite ready to fill that out, what's the next step? That type of stuff.
Go to our website, ecommercelending.com. If you have more specific questions, just email me, Stephen, and that's with the PH at ecommercelending.com.
Okay. And then anything coming up? You mentioned earlier you guys went to some events and stuff like that. Do you guys go to events and anything coming up cool that's happening in the next few months or
Not next few months. A lot of events are later this year.
Yeah.
McGuire Woods Independent Sponsor event is one. There's an SIG event, I think in Dallas in September as well. Prosper's coming up in, I believe, April. We are not attending Prosper this year, but that's more of an online event. But there are a few M&A groups on LinkedIn that you could follow, and they're all host a lot of events are coming up. Just we're very selective on which ones we actually go to.
Yeah, we put them in our newsletter when we find them. It's one of the reasons I always ask our guests, "Hey, you know any cool events coming up?" Because we have a growth and acquisitions newsletter that we run, and at the bottom of it, we have an events calendar. So we're always looking for, "Hey,
Yeah,
what's out?"
cool.
I Google around a lot too, but sometimes things just don't show up well in Google, and you'll know more about it than somebody hasn't promoted or had the SEO right. There'll be some cool event out there that slips through the SEO cracks. Well, I want to thank you for being here. Thank you for teaching us. We've asked a lot of questions. If somebody can only walk away with 2 or 3 takeaways for today, what would you want them to walk away with?
I would say get pre-qualified, have your lender pre-qualify the business, and put together your acquisition success team before you buy a business. I think those are the three takeaways there.
That'll help them get to the success. Well, thank you again for your
Just have
time.
your ducks in a row, and it'll happen. And lastly, have patience. You're not buying a house; you're buying a business. It takes a long time to find that right opportunity.
Awesome. Well, thank you for being here today, and we'll call that a show.
Ronald, thanks for having me.
All right. I want to announce our new channel partners, the ITX Marketplace. Since 1998, ITX has created $5 billion in value by selling more than 225 IT businesses in 20 countries. ITX works exclusively with IT-enabled businesses generating between 5 million and 30 million who are ready to be sold, and M&A decision makers who are ready to buy. For over 25 years, ITX has developed industry knowledge that helps determine whether a seller is a good fit for their buyers before making the match. ITX Mergers and Acquisition Marketplace we have partnered with has a proprietary database of 50,000 plus global buyers seeking IT service firms, managed service providers, Microsoft service providers, software as a service platforms, and channel partners with Microsoft, Oracle, ServiceNow, and the Salesforce space. If you have an IT-enabled business you're ready to sell, I want you to visit the itexchangenet.com/marketplace. How to exit. That link will be in the show notes. Visit them now.